Wasting my breath. All right. So, good morning, good morning, good morning, Grand Rising. We're going to start again. We should have sound, we should have picture. And this was the US 30 chart. Can you recall, all right, that we put these two levels up? We said that above here, there's liquidity, all right, which is a pool of money, all right, and price likes to travel towards liquidity. We said down here, there's also liquidity below the bottom of the range. And I said the problem with this range on a much larger time frame, have a look. I was saying that there was liquidity here, this dotted yellow line, where price just poked its head over here. All right, it came above here, captured this liquidity above here, but it essentially pushed. And as soon as it pushed above it, as soon as the market pushed above this liquidity level, price started to go sideways. Okay, as soon as it pushed above here, which is Christmas, nearly Christmas Day, that's how close it was, yeah? The price started to go sideways. From being bullish, making higher highs and higher lows and higher highs and higher lows, price started going sideways in US 30 since Christmas, okay? And the issue is that I believe that there's a possibility that this market might be, this boat might be turning around, okay? Why might it turn around? We spoke about the imbalances that were below. This is imbalances on a much larger time frame. We're talking about weekly and monthly imbalances. Yeah, have a look at it on the month. Okay, have a look at it on the month. Have a look at it down here on the month. Yeah, have a look at it. All of these imbalances. All right, guys.
I got football at school today.
Yeah, okay, well done. All right, have a nice day.
Bye.
Bye-bye.
Bye-bye.
Sorry, guys. Hurricanes just burst into my office like they run the place. So yeah, so this is these are big monthly reasons why this market might decide to start getting bearish. And since Christmas, we've seen this market go sideways. All right, have a look at the sideways price action. And the issue is when you're in any range, we want to ultimately, the top of that range, as Snipes told us the other day, is premium, and the bottom of that range is ultimately discount. All right. So in a discount, when things are cheap, we want to buy. And in a premium, we want to sell. And really, we want to take action. That's what we want to do in a range, or we want to wait until the market breaks outside of a consolidation range to give us an idea of what's going to happen. Now, on a smaller time frame, we identified this smaller consolidation. Remember, guys, the receipts are that these sessions are recorded. So if you can't remember me saying these things, you can't remember these things being said, or I'm lying, or you're going to say Jay said something else, just go back, watch the videos, and skip in and see what we were saying. All right. So this was yesterday's Breakfast Club. I thought I put the line in, but evidently the line's gone somewhere. Thursday, let's say about here. Okay, make sure the time's in the right time zone. Okay, yeah, it was about here. It was Breakfast Club. Can you see my scribbles are still on here? And my scribbles are, was it going to do this, or was it going to go the opposite way? I think maybe I've deleted the other scribble. All right. And I said that the market is trading within a range. It's trading within this high and this low. All right. This was another high it was in, but this is the real swing high, I recall saying yesterday. All right. Okay. Now let's have a look at what happened. All right. Let's color this in properly. Let's have a look at what happened. This is the range that the market was trading within. Okay. Let me get rid of that. Here's the wick. I want you to understand this, because this is how you're going to be able to get into trades, by understanding what's happened in the markets. This market was in a consolidation range. There's smaller ranges within here, but we're taking from this little wick high over here to this little low over here. All right. We can see smaller little ranges, and you can draw some more little boxes in here if you really wanted to. Okay. But ultimately, the market's trading within this range, going sideways. Now have a look at this. This little pop above this little area here captures the liquidity that was sitting above this high, and it also closes up imbalances that are sitting in the market. Here's an imbalance. All right. Here's an imbalance. And even there's a little bit of imbalance just above here. Can we all say, yes, we can see this? Can we all acknowledge that we can see this imbalance that's sitting here? have a look here. And on this time frame, I've drawn two. If I maybe went to a larger time frame, it might just be one. Can we see these imbalances in here? Everybody say yes, amen, we can.
Yes.
Yeah. Great, great, great. So I'd love to get a little feedback. All right, we can see these imbalances in here. So the market popped its head above here, above this liquidity here, and closed this imbalance. And as soon as it did that, whenever markets capture liquidity, we have the understanding that they like to run in the opposite direction. All right. So nam captures liquidity. Then remember our concepts. It's indication, it's correction, and it's continuation. Did the market continue? No, didn't continue. It just came up here and nam, closed the imbalance and started to run in the opposite direction. If you was on a small enough time frame, you'd be able to, I can see it here in my 5 minutes because I can see the way the price is movement, price action. But you may have to drop your time frame down to see this market break structure. This is structure over here. Break it, make a retracement up into this level, and then continue. All right. Watch it on a 1 minute time frame so you can see it. Now, I don't like to teach and tell people to go all the way down to a 1 minute time frame when we're in this learning phase, okay? Because it's very noisy and you can get trapped there. You can get sucked into this 1 minute world, which just takes your money. That's all it will do. Yeah, that 1 minute world will take your money if you're not, well versed and know how to control your emotions and make you overtrade because things happen so quick. All right, you'd be in and out of a trade in 2 minutes and think to yourself, I have to take another trade and another trade and another trade, and before you know it, you've blown some accounts. All right, so here's some structure. The market broke down below that structure. In 1 minute, you actually can't see the retracement that great. All right, but even if you wanted to say broke to here, retrace, close back down below, even if you wanted to say that, that could have been your entry as an aggressive entry. A clever entry would probably have been above here because of the imbalance here that's formed. Okay, but either way, even if we put both of them on, we put this here because you wasn't able to see a retracement on a smaller level. Don't get twisted. There is a retracement here on a smaller level. It's just too small. It's smaller than a minute. All right, so it's unnecessary. So for argument's sake, if you said this one and this one here, put them both into play, we can see which one's played out. Well, both of them did. They both played out and they both pushed down and grabbed the liquidity that was sitting on the other side of the range. All right, have a look. This is what we spoke about yesterday. Grab the liquidity that was sitting on the other side of the range, other side of below this range. And what we actually saw here is we did see on, let's go to a smaller time frame so you can see it. Again, another play, a trade that could have been taken, all right, was the market broke, retrace, closed back down below. Now, it's not a big trade. And I'm going to explain to you why it's not a big trade. So we've come from here. We've seen if you were able to saw this liquidity grab and you got in for this sell down here. Okay, great. Okay. Now, if you were still in that trade, great, fantastic, everything's going good. Everything's going good because the market pushed all the way down to here. But let me show you, if you didn't get into that trade initially when it broke up and grabbed the liquidity, nam. And let me show you why you would have stayed into this trade. You would have stayed into this trade bearish. Why? Because the market broke the 50% level of the consolidation range. This is just my gem I'm giving to you. If you see markets consolidate and then there's some sort of retracement that happens back into the consolidation, that 50% level is a landmark. That 50% level, so when it came up here, nam, and it came down here, if it breaks that 50% level, it is a big signal. It is a big, I don't know, big signal to you that the market wants to continue going down. If the market came and didn't break that level, then yes, it could continue to go up. But this is another bit of confluence that if I got in up here after seeing this liquidity grab and close of the imbalance, and then I saw this push that broke the 50% level, there'd be an added bit of confluence for me thinking to myself, you know what, that the market is going to continue going down. That the market is going to continue bearishly, which it did. Now let's imagine that you didn't get in from up here and you saw the market break, retrace to close this imbalance that was in here, and then close back down below. That could have been your trade. All right. And let me explain something to you why this trade didn't keep running in this direction. Have a look over and over and over again. It's because when it grabs liquidity from below this level, look at this little grab, nam, 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 nam. After it does that, the market has a tendency that it wants to run in the opposite direction. So personally, I would have either secured my profits at this point here, or would have closed out my position. I would either secure my profit, as in secure some profits, move your stop, whatever it may be, or because we understand how this market works. It just wants to grab liquidity. Every time it grabs liquidity, it runs in the opposite direction. Look at liquidity above these highs here. Look, nam, 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 run in the opposite direction. Yeah, liquidity above these highs here. Nam, 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 run in the opposite direction. Now it's taking this liquidity from here. Nam, 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 run in the opposite direction. It's what the market does over and over and over and over and over again. And we've already said, have a look. Because someone's saying, well, Jay's trading it up, he's trading it down, he's trading it left, he's trading it right. Like, which way is the market going? Well, we've already said from our higher time frame analysis that we don't know which way the market's going. It's in this consolidation range, trading within this range. If anything, the best play we could have taken here was a buy at the bottom of the range, because the market has been trading within this range. So though I was concerned because this market, and which I still think is going to be the case, I purposely put out these levels here because I said to you, I believe that even if this market wants to go down here and break outside this consolidation, I said it may go up first before going down. Why? Because there's a big, massive pot of treasure at the end of the rainbow over here, which is liquidity sitting above all of these equal heights. I did say, whoa, it's a bit of a journey up here. It's about 600-700 pips. So therefore, you know, actually being in this movement up is still a trade that could happen. But this is what I'm saying, and this is why the market's the same, just on different time frames. It presents to you different candles. The strategy is the same. Everything's fractal. Because if we're looking at this in a much larger time frame, all of this energy above this yellow line is just a liquidity grab. When we start to zoom in and we start seeing the momentum coming at the market, we start noticing, okay, the market's going sideways in here. But ultimately, if we're saying this is just a liquidity grab, maybe the overall picture of this market's going to go this direction. Maybe. Maybe. Not for certain, because I don't have a crystal ball, but maybe. However, as mentioned, when we saw this consolidation, I said the concern is that we're at the bottom of the range, and the bottom of the range is buy territory. And we identified this smaller range, because I said if we want to take a trade today, we want to see what this market does outside of this range. And what did it do? Nam, 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 ate the liquidity, and then ran in the opposite direction. If you had got in the breaker structure, which I showed what an entry would be, all the way on a 1 minute time frame for a breaker structure, I thought maybe it would be slightly better, but it was still good. Okay. The slightly better entry would have been somewhere all the way up here, which let me see. Yeah, to be honest, there is one. Have a look at the entry on a 1 minute time frame, a much better one. You ready for it? Here's my data points. There's one that's like this. And someone's saying, why is that one there, Jay? Because I've touched this data point. Oops. Because I've touched this data point and this data point. But there is also one which is the point before the highest point in the market, all right? The last highest point. So say, for example, from this data point here to the last highest point, because this is the highest point here, the last one, oops, the last one, come on, the last one over here. And this was the last lowest point, which gives us structure. Just like this structure here. All right. And as we can see here, I'm on a 1 minute time frame, which I don't want to be, but I'm just showing you the better entry. If I'm looking at that and I can see this fast price action that just grabbed liquidity above a high and closed in imbalance, and then I start to see this, have a look at our strategy every time. Indication, which broke this structure. Correction, that retrace back and close some smaller imbalances, and then continuation with candles closing down below, by all means, that's an aggressive entry above the last low. That's a smarter entry above the swing high. So above the last high, and that's a smarter entry above the swing, stop loss above the swing high. That could have been your entry right there. And as I said, I would have been watching this trade going, is this going to break the 50% level? I'd have been in the trade now, rubbing my hands together, going, okay, I'm in profits. Fantastic. Is this going to break this? Bang. Broke the 50% level. I'll be like, okay, yippee-ki-yay. I understand the market's got to retrace. The fact that it only retraced to here is a blessing. It could have retraced all the way back up into these levels because there's imbalance in here. It left that imbalance, and I'll come back up for that later, and it continued to fall. Have a look. When it broke outside of this range here, grabbed the liquidity, nam, 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 nam. What did it do? Runs in the opposite direction, closes some imbalances again. Imbalances in here, closes the imbalance. And then it comes and it closes back down below, showing its intention that it wants to continue going down. And it did continue going down, all the way down to here, meaning that initial entry all the way at the top on a 1 minute time frame. This is a 1 to 10 trade at this point in time. Whether you stayed in it for 1 to 10 would be great. But even if you took the other entry or this one here, this then becomes a quick 1-to-1 trade that you have to keep your eye on it because you understand how the markets work, and that below this swing low over here, there is liquidity. So as soon as it nam eats that liquidity, we understand this market wants to run back in the opposite direction. And you must assume that the market is just always chasing the liquidity. So when we see here down here, we would have locked in profits. Even if you didn't get a great entry all the way from the top here, you'd have got a 1-to-1, a 1 to 1.3, a 1 to 1.4, whatever it was, and you would have taken your profits. Okay. Now, bearing in mind that we're at the bottom of this range, I'm explaining out this story to you. All right. Should I come out to 5 minutes? Let's have a look. We could come out to 5 minutes. Bearing in mind we're at the bottom of this range here, which let's look at this green block. We understand is buy territory. When I see this happen, and this is structure, have a look coming down. This is structure. Why is this structure? Because this is the highest point here before the lowest point. So if I was looking at structure, I'd be looking like this. So that is significant structure. So when we've seen this happen here, boom, this break of this significant structure, which is this push here. Sorry for my charts looking mad. I will wipe them in a minute. Yeah. When we see a break of that structure, we see a retracement, and we see a market. Look, it didn't quite close above here. Let me get rid of this stuff because I'm drawing in highlighter pen. Let's try and clean this up because the YouTube people are going to be like, I can't see what he's doing. Looks like he's working in crayon. All right. Let's get rid of all of this stuff. All right. When we've seen a break of this structure here, on the 50-minute time frame, we've got a close above, we've got a retracement, and we've pushed over here. We haven't got a close above these levels here. We've got some wicks above it, but not a close above it on the 15-minute time frame. So if you was wait on the 50-minute time frame, you would have to wait for a clear closure above. I said to you, I don't mind you guys going down to a 5-minute. I think that's, a nice balance between being quite small, having a nice smaller entry, and not too small where you're messing with the minutes. All right. So here we've seen, boom, a break and a close above this structure. Yeah. That I said was structure over here. Whoops. That I said was structure over here. The last high before this lowest point. Boom. And then you're waiting for a close back above this level here. Look, you don't get this close here. This is just wick. So you're waiting patiently. Once it doesn't break this level, you're just waiting for a close above here. Have a look at your close above here. Right here. If you're wicked and bad, that is your entry. Okay. And your stop can be below here, covering you for this imbalance if the market decided to come back and close this imbalance. Because it's easy in hindsight to go, well, it just went up into space. But in reality, it would look like this. And you don't know what it's going to go and do. That's the reality. This is what the other traders and other educators, they don't want to do. They want to go, oh, yeah, we went in here. Look at this. As soon as we got in the trade, boom, it went to space. Okay, in hindsight. But what about it possibly coming back here and closing these imbalances? or doing something else. All right. So as you can see here, that is a close above that level here, above these wicks. And yet that could have been your signal to get in the market. And I would have advised you to take into consideration these imbalances in here. So the safest place probably would have been a stop over here. The aggressive place would be below the last little low energy that you see happening in here. That's a very aggressive entry that you're just getting in. All right. Let's leave it here for now. Okay. Everything's going good. Everything's going good. Have a look. Everything's going good. Yeah. By now, this is completely risk-free. Because at this point here, we're at a 1 to 1.6, completely risk-free trade. All right. And now you're just simply asking yourself, where could this trade be going? And I'm saying this. If this market is trading within a range, a key area of where this trade may be going, I'm going to identify is the 50% of the range. When have we heard that before? I've heard that before when we was talking about this smaller consolidation here. 50% of this range, this bigger range, is going to be a landmark for me also. All right? You can do that by your Fibonacci's and all this kind of stuff, but you can just draw a box around it in the middle of your box. Okay? That middle point of that box. All right? I'm going to do it with the Fibonacci here, no problem. From this high, oops. I don't know why I keep selecting the wrong. From this high all the way down to wherever that low was over here, that 50% level where we're sitting right now is a landmark for me. You see, because there's 50% here. I do have 618786 involved here as well, but that is a landmark. I'm like, okay, what is this market going to do right now? Because that's going to give me some sort of insight of whether this is going to keep going up to the top of this range, which it's allowed to do, which it's supposed to do. Because these markets do what they have always done over and 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 over again until they decide to do something different, So although I may be wishing and willing and praying to the pit gods that, yeah, this is just wicking up, grabbing liquidity, then it's going to go to hell and close this imbalance, I don't know until it shows me, until it gives me the information. So right now, if I got in this trade right now, I'd be, protecting my position or taking my profits. Okay. Especially as when it got to that 50% level, what did it start to do? What did it start to do as soon as it got to that 50% level? It's like the hokey cokey to me. It looks like it's just going sideways to me. It got to that 50% level, which I just removed my Fibonacci, but believe me, it's right here. It's about here. And then the market has started to go sideways within this yellow box. And even you can, get a little tighter consolidation happening in certain areas within there as well. But ultimately, we're trading within this range and this range and this range is what we're trading within now. And the question I'll be asking myself once again is, what is the market going to do? Are we going to do this and decide we want to go all the way to the top of the range? Are we going to do this and decide that we are ready to start coming back down and maybe breaking outside of that consolidation? At the moment, I don't know. I wish I knew. I don't know. But it's the fact that I don't know it's going to make me a better trader because I'm going to be patient and wait and let the market show its hand. Okay, no problem. Cool. Let's go move on to something else. Has everybody understood my breakdown? Is there anything that you want me to touch back over in regards to what I've been saying about this market? Do not feel as though you need to sit there quiet and not say it, because you're here for your own learning. Yeah? You're here. You have to be that kid in the class with your hand up. Otherwise, you're not going to learn. You might have missed something and that you need to know. If not, I'm going to move on to another pair. We're going to break it down and see what the other pair's done. Coolio mulio. All right, no problem. Let's go and look at USD JPY. Because we was looking at the Dixie, and I was saying about the Dixie that The US dollar, let's go to the Dixie first so we can have a nice better conversation as well. I was saying the market broke structure to the downside, but we may see a bullish push to close some imbalance before it decides to do what it's going to go and do. Let's rewind back to yesterday. Yesterday, Breakfast Club. All right. Here, this is the Breakfast Club yesterday. Here, put a vertical line. Thursday about 8 o'clock. All right. Look, you can see my scribbles are actually on the screen. My scribbles are on the screen saying that let's zoom out of here a bit. Now, though it didn't break and come down here, it's fine. The first thing that I was saying is look, let's get rid of that. I was saying that the Dixie has broken structure over here. However, when we understand and we see a break in structure, the same talk about liquidity, what it does when it does next, I'm expecting to see some retracement. The retracement that I drew was only to about here on the basis that the market continued coming down here. Fine. It didn't continue coming down there straight away. It made a deeper retracement past that little point that I drew it, because at the moment, it still made a lower high than here. So at the moment, this market is still potentially looking like this. So I don't know from when I'm talking in the day how quickly this retracement is going to play out. Whether it's going to play out very quickly, a nice quick retracement in here, and then continue going down here, or for the whole day, this market's just going to be bullish, pushing up in here, making its retracement, which is what happened. So if this market is bullish, the dollar's gaining strength, the USD JPY, what do we think might, unless the Japanese yen by itself does something else and gains substantial strength, balancing things out. If this Dixie dollar in its retracement that we identified was going to happen, the only thing is I drew it like this before and thought it would just maybe close the imbalance and keep coming down, but it's made a bit of a deeper retracement. All right. But if we're thinking that this dollar was getting stronger, what do we think happened to the UJ? Unless Japanese yen got very, very strong. What do we think happened to UJ? What do we think happened to UJ if the dollar gained strength?
Yeah, usually the dollar would go up, and if the dollar gains strength, so we'd see a bullish impulse.
Okay, let's have a look. Let's go and see. Let's scoot back also back to Breakfast Club, which was this vertical line here. And what we saw when we was talking about UJ is, let's go over here. Let's go back. I said, because you can still see my drawings on the screen. I said this market is trading within this blue line and this blue line. It's within this range. And because it's still within this range, this market is still bullish, meaning it's still been making higher highs and higher lows and higher highs and higher lows and higher highs. And even if it comes all the way down to here, which is where we were on Breakfast Club, it is still bullish. These were my exact words. Run the tape back. And we were sitting here and we're thinking to ourselves, look, this market could be coming to break this level here, which look, you can see here, I've had my little levels here, waiting for it to break. I've actually still got, no, I'm going to tell some lies there, but it's not there. All right, I was going to say that there was an alert there, okay. The market came, this is, let's go to a 50-minute time frame. And we saw this market push back into here. This is 10 o'clock. So now from this lowest point here, this means this is structure. We've seen the market come up and push above structure. Wick above structure on the 50-minute time frame. On the 5-minute time frame, it broke structure and closed above. Let's have a look. No, it didn't. All right. The 5-minute time frame over here, it didn't break above structure here, but it did over here. Okay. And it not only started to break structure over here, it's now price is breaking outside of the market. The market meaning this trending range down here. The market, the price is broken outside of this trended range. So I'm like, wait a minute, everybody's running in this direction. Everybody's running in this direction, and I'm running with them. Like, yeah, I'm going with the trend. All of a sudden, some shift starts happening. People start saying, oh, okay, we're going to start coming off the track. So I'm already thinking to myself, okay, something's going down. All right. And we can see here how the market, trying to see where we're on the, let me go to the 5 minute, 50 minutes, sorry, just to make it easier. All right. We've seen how we had this market was here. No, let me go on a 5 minute. Structure, this is the structure, because this is the lowest point on the larger time frame here. This is the last high. So this is the level of structure that we want to see a break, a retracement, and a close back above. It's this level here. It doesn't come here. Okay. I was trying to go down and backwards and forwards because I wanted to see it just a cleaner way. This is not a closure above this level. Let me not do that. Let me do a line so we can see. Let me do a line so we can see. This is not a closure above here. Okay. This is a wick above here. Okay. We want to see a nice solid closure above this level. And we only really get it here when the market kind of closes. Then we get a retracement here. And then we get a close back above. Have a look. So on the 5 minute time frame, this with a very aggressive entry would have been below this last low, below the retracement. And a cleverer low would be below where you can see more of a swing level. All right. So here's the structure going backwards. There's structure here, there's structure here, and this is the bigger swing level. Now, if you was very, very conservative, you placed your stop here, no issues. You've had no issues, even by this wick that came back down here. If you was aggressive and you went against that last low over here, you would have probably got stopped out here. Is what it is. But you wouldn't have lost money. Even if you took a more aggressive entry over here below this last retracement, because this is a retracement, guys. This is a closure above, and then straight away a retracement all the way down here, closing the imbalance, and then a closure back above here. And even if you took that trade, that's a 1 to 2.5 trade. There's no way possible you should have lost money there, because your trade should have been risk-free, or you should have taken your profits. Okay, but we did see a return back over here. Let's have a look why. Let's try and look if we can see why. Have a look at why, guys. Can somebody tell me why? I want to do this. Can somebody tell me why? To see if you have been paying attention. Why did this market push up here and then kick all the way back down here? That's your clue.
Liquidity grab?
Yeah, every time. Every time, over and over and over and over and over and over and over again. Every time. If you're looking at this chart here, this push here, this has to be the most significant place of what we can see here. Why? Why does it need to be, is it the most significant place here? Why? Why is it the most significant place? Tell me why. SS. SS is what I'm looking for. SS. Why, if I was looking at this little energy here of how this market was coming down, would my eye be drawn to this particular high? Tell me, come on. Challenge yourself. It's because of the strength and speed of this push down from here. This is a major swing level, because when the market came that up here, it went boom. Red candle, red candle, red candle, red candle, red candle. My eye has to be drawn to this level over here. Traders that took this trade placed their stop losses above this level. Like, oh my God, look how strong. Look at that level. Wow. When the market comes back up to here, they were saying, you know, it's going to fall to hell. Boom, 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 boom. The market says, okay, no problem. They placed their stop over here. Nam, 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 ate the liquidity, and then it runs in the opposite direction over and over and over again. It just happens over and over and over and over and over again. It's crazy. Then we've seen the market now go sideways. If we was looking here, this market is trading within this range, it's going sideways. Have a look. We've got a break of this range here. This is a closure above it. This is a retracement in here. And again, only about over here, you'd say was a closure above. And once again, if you was very aggressive and you place your stop here, you would have got to a 1 to 1.9, but then you would have, so yeah, it is this, let me put the correct entry. This is the break, the retracement. If you place your entry over here, and use aggressive below the last low over here, you'd have seen this market turn around straight away and stop you out. All right. But I would have been like, do you really want to place your stop here when you can see imbalance just below? And this is just the aggressive entry. Like, you're being aggressive and ignoring the imbalance. It's either you're not going to be aggressive and you're going to place your stop below the swing low. But if you are going to be aggressive, you can't ignore that just 2 millimeters below you, there's imbalance. So at worst case scenario, you should place your stop not even here on the imbalance, but below that low, this little wick low here. Yeah. And then another profitable trade. There's no way possible you're going to lose money on this trade over here. As soon as you get to a point where you're risk 1-to-1, you should be risk free. And then you should also be looking. Let's have a look here. I'm going to make a little line. Horizontal. Let's have a look. Let's have a look over here. Let's see what's going on. Well, what's gone on here is this was the level of liquidity, the high, and nam, 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 nam. As soon as we grab that liquidity, what are we expecting? A run in the opposite direction. This was the high over here. This was the liquidity the market chased. And it went and it grabbed it, it busted, it took everyone's stop losses that had stops over here. And then as soon as it does that, it runs in the opposite direction. So if you was in this trade, as soon as you got to this level here, and that would, to be honest, that would have dictated whether you even got in that trade or where you place your stop. Because you can't get into this trade here on the basis that this market might be going here. Like, this doesn't make any sense. I'm not going to get into a trade here and place my stop all the way down here on the basis I'm going to get a 1.5. So that dictates whether I would have been in that trade anyway, or how I would have placed my stop. Maybe I would have been in it extremely aggressive and got stopped out. Maybe I wouldn't have, but maybe. Okay. But as soon as it grabs this liquidity, this whole little bit here, I'm thinking to myself, yeah, I'm looking for any excuse for me to get in, for it to run the opposite direction. Let me show you the excuse, guys, because this happens. We've seen this happen. Oh, what is wrong with this? I keep selecting. I'm going to wipe my charts real quick, guys, because it's annoying me. All right. Have a look here. This is the trajectory. We're connecting some dots. Let me get out of the 1 minute first. We're connecting some dots here of some structure. Okay, so the market structure was like this, and then we've seen an acceleration like so. Why is that an acceleration? Why have I drawn the angle like this? Because I want to touch the last low before the highest point. So I want my data points from starting from, you know, here, touching some points. Have a look, touching some points. But I want to make sure I get that last low in before the highest point. So that is my structure here. So for argument's sake, let me, on my 1 minute time frame, as soon as I've seen that liquidity being taken, let's have a look at where that line was, where that liquidity was. Okay, let's go all the way back here. As soon as I've seen that nam liquidity being taken over there, I'm waiting for any excuse to get in for the sell. Or on a better, even this time frame here, liquidity above here. I'm looking for any excuse to get in for the sell. And what is that excuse? Only way we can define it as breaks of structure, indication. This one's a little bit tight, to be fair. I can't say that this has broken this structure. It broke a little level here, but it didn't break this little wick here. But this here definitely is an indication. This is a retracement in here, correction. So this is the level here I'm working with. This was an indication of where it wanted to go. This here was a correction. Now, I don't know where this correction is going to go. In hindsight, I can see it just only went up to here and closed 50% of the imbalance. But I don't know if it wants to go all the way back up into here and not break the structure. I don't know. This one is corrected to here, closed back down below for all purposes. Have a look. That is an aggressive entry right here, getting into that trade. If I wanted to, I probably would have taken into consideration the imbalance over here. If you wanted to, you could be a cautious trader. And this is something that you've got to test out of whether or not you want to. Personally, guys, it's like this. Go for the safer stops and start getting some your confidence up and start getting some consistency in your trading by taking the safer stops. Meaning that this same trade here that went, look, have a look at this trade. That went all the way down there, and that is currently sitting at 1 to 5. The aggressive entry, have a look. This was the break of structure. This was the retracement. This was the close back below. The aggressive entry is here, maybe just taking into consideration that imbalance plus your spread. Is in a very aggressive, it's 5 pips. Now, in this instance, it worked out 1 to 10. Yeah. But I'd say make sure you're putting your stops above like those significant highs. Even if you want to be really safe because, you know, you've been getting too many L's in the market above the swing high. Yes, it's going to reduce your R to R. Now this just went to 1 to 2.6, but maybe it will get your confidence up that you're successfully getting into trades. If you don't have those confidence problems, cool. Start reducing on what high you're going to be placing these stops. Maybe medium high, or maybe the most highest risk one above the last high. This is the break of this structure here. If you can't understand why I've said that candle, look, let me put a line here. This candle closes below that level. Let me make it a different color because there's lots of yellow lines. This candle closes below there. Then there was a retracement. Then there was a closure below. Because I'm looking for any excuse to get in for the sell. Because I've seen how this market has just captured liquidity. Above here, it grabbed liquidity. And on a bigger time frame, above this level here, it grabbed liquidity. And I understand when it grabs liquidity, it likes to run in the opposite direction. I don't want you guys here on a 1 minute time frame, but I just showed you what that entry was. On a larger time frame, 5 minute, the market just went to hell. And there isn't a clear place. Well, you can still see here the break of this structure, this retracement is closed down below. But to a beginner's eye, you can't see that clear correction until we get down here, correction, and a little bit of a continuation. All right, so maybe somebody who's turned around, someone has turned around and said, has got in this trade like this. Maybe. Let me zoom out and see why they would have done that. Or why that somebody may have done that is because they think that we're at the top. Try not. Let's have a look. This is the daily time frame. So I deleted everything off the chart, didn't I? So that's why I'm putting it back. All right. We've seen this kind of energy in here like so. You see me put 2 little levels in here. This is the larger range, and we've seen some smaller energy in the smaller range here. And to be fair, yeah, I mean, I wouldn't be quick to be turning around and saying that I'm going to be in here for the sell. Why? Because we're in the middle of the range. There definitely may be some sort of retracement because there's 50% in the range. All right, there might be some sort of retracement, but do I love it here, right in here on a much bigger picture? Possibly if we do this, have a look. I'm going to show you, once I open up make the time frame smaller, you'll see why this is relevant. Because the market is trading within this range here. Watch when I drop my time frame down, it becomes a bit clearer. See? And on that basis, maybe someone would say that we're near the top of the range. Maybe. Yeah, maybe. There is definitely some imbalances in here. There's definitely this market could come and retrace back to some of these levels in here. But yeah, It's a bit iffy at the moment. All right, look it on a larger time frame. Remember I said to you about the liquidity grab? The market was going sideways in here. Nam, 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 liquidity grab, running in the opposite direction. And to be honest, if you want to go by what I was saying earlier, it's broken that 50% level of the consolidation. So maybe we are going to see some bearish energy. But that bearish energy, I don't know whether that bearish energy is going to break outside of the box, but we might see it get back down into the bottom of the box. Maybe. All right, because it has kind of broken that 50% area of this consolidation range, which is kind of an indication for me of what it kind of wants to do. Only problem is when I'm looking at this now, as it's just broken some structure here, structure. This is structure over here. This is probably some more structure here, some more structure here. As it's just broken this structure, and I can see imbalance, even a little imbalance in here also, that this market now may decide, I'd like to see, obviously it's broken this structure here. It might decide that it wants to run back in here first and then go down, which is what I kind of drew here. So therefore, the only way we can trade these markets as a day trader is to be able to trade what we see. If I was a much bigger swing trader, I'd be like, cool, let me just slap in a sell and put my stop 400 pips away. But as a day trader, we must trade what we see. So at the moment, this market is making bearish action, bearish energy in this 15-minute range. And we might see it push down here. And if it pushes down here, I'm not going to be selling at the bottom of the range. Because at the bottom of the range is when price is cheap. All right, even though the market's coming down here, I'd want to wait till we get back up into this level here, touching this yellow line, and then maybe try and sell. And ultimately, I prefer doing that outside of this yellow consolidation box. So now, if we see a small little retracement, if I drop here, we see a retracement back into here, I say you can get in for the sell. If we see a smaller retracement into this kind of level up here, closing some imbalances, you could get into the sell here. But you must understand that that journey might look like this when you get into that trade from the sell. It might come down here, they might come back down, bring you all the way back to nearly nothing, and then it might come back down a little more, and then you're at the bottom of this range, it might consolidate, might come all the way back up into here, and then maybe you might do this. Or maybe it might come down here and just say, no, Jay, I'm not done. I'm not done in this consolidation range. I want to go back up here. And then I'll come back down here, then I'll go back up here. Could do. Could do. All right. So like I said to you guys, good morning. I hope that, I've been able to show you an insight of the kind of level of questioning and story narrative you should be building up with each one of your trades. Nobody knows what's going to happen in the markets. Now, when you combine this, guys, with, I'll show you what we're going to do. We're going to do 7 minutes of just speaking about our risk management. Okay, guys, how much should you be risking per trade? How much should you be risking per trade? Let's imagine that you have a $100,000 account. How much should you be risking per trade?
1 to 2%.
So 1 to 2%, he says. Okay, so is this a prop firm challenge or is this your own money? That's a very good question. It's very relevant. Is this prop firm or is this your own money?
Own money.
Your own money, okay. But this is your own money, then fine, I agree. Yeah, your own capital. 100,000. I'd say 1 to 2% is cool. All right. Own capital, 100,000. I'd say 1 to 2% risk is cool. Meaning that you're slapping trades and you don't mind risking £1,000 per trade. All right. How many trades can you take at once? How many trades can you take at once? Oh, I just complicated things, yeah?
As many as you want. I'm not sure.
As many as you want, he says. As many as you want. Okay, so let me ask you a question. If you take one trade at 1%, meaning that you're risking £1,000. what would happen if you, whilst that trade was running, you took another 5 trades, risking 1%? How much would you be risking at once?
6 grand.
6 grand, which now means you have a 6% exposure, which means that if you're a nutcase and for whatever reason, all of those trades go bad, you've just lost 6% in your account in one day. How many days does it take for you to blow your account, losing 6% of time in one day? Less than 20 days. Probably about 17, 18 days. Your £100,000 of your child's inheritance is gone down the drain. Yeah? So there's no way possible that you can take as many trades as you want at 1% risk at a time. Because that doesn't work. You could get up to 100% risk. Well, you can't because your margin wouldn't allow you to do it. You can't. You want to be you want to be having a risk exposure of 1% at a time. Now, let me explain something to you. That does not necessarily mean that you've only got one trade running at a time. It just means, let me tell you, for me, if I take another trade, whether it's in the same market or another market, it means that the first trade is what? What have I done to the first trade to be able to take a second trade with that 1% or 2% risk? What have I done to the first trade to allow me to take another trade at 1% or 2% risk?
Close the trade.
Nope. I'm going to close it.
You minimize the risk.
Elaborate on me minimizing the risk.
So instead of taking 2%, you've taken 1%, and you've used another 1% for the other trade.
Possible. Yeah, possible. I'm going to give you the answer. That's the answer. But I want to just leave it at 1%. Guys, that first trade I've taken is risk-free. I can't lose no money in that trade. So I've taken a trade. It's going well. It's an upper 1 to 2, whatever it may be. It's completely, I've moved my stop loss to my entry. I cannot lose any money. So from my 100 grand that's sitting in there, I'm now at 101 or 102,000, and I cannot go anywhere lower than 100 grand because I've moved my stop loss to entry, maybe even bank some profits. Then I can take another trade because now I've only still got 1% risk. And when that trade becomes profitable, I can take another trade. That's how you should start off as a beginner. When you get a bit more advanced, you can balance out your profits and say, well, I'm at a certain amount of profits up and you don't mind doing certain things. But I'd say to you for now, your 1%, it has to be a 1% exposure, not 1% per trade. This is your exposure. This means if hell freezes over, you're only going to lose this money. All right? And this is when it's your own capital. Remember, when you're doing a prop firm challenge, you can only lose 10% of this money. You're only allowed to lose 10K, which actually means that £1,000 out of 10K is how much? What is £1,000 out of £10,000 that you're allowed to risk before you blow your account? But it's 10%. If you really think about it, it's 10%. That means you can only lose 10 trades. Yeah? You can only lose 10 trades before you've blown the account, because you're not allowed to lose 100,000 out of a prop firm challenge. You can only lose 10. You can only lose 10 grand out of your 100 grand. So this is where the prop firms get everybody and why so many people don't achieve nothing. Because ultimately, for a start, they're like, yeah, I'm at 1% of 100 grand. You are, but you're at 10% of what you're allowed to lose. If this was your own money, it's different. Because if it's your own money, you could go down £88,000 and then rise like a phoenix and make 200 grand out of the account. Because it's your money. With a prop firm challenge, you got 88,000, you've blown the account. You need to get your credit card out again and start again. Guys, good morning. We're going to go more into obviously the risks and stuff like that and managing the risks. I hope you learned something today, and think about what I've said there. You cannot take multiple trades at £1,000 because then you're going to be at £6,000 at risk. You have to make sure that first trade is risk-free to be able to allow you the bank to be open again for you to take another 1% risk. If not, just take one trade at a time. bank the money from that, and then look for another trade and then bank the money from that. You don't have to have multiple trades open. All right, if you don't know how to manage things like that. But guys, good morning, God bless. It's Friday. We a little bit thin today, not too many people on the session. But either way, I am grateful and happy for you guys to be here. Have an absolutely fantastic day. I'm going to put something that is going to inspire, I think. I'm going to put the greatest motivational speech of all time, it says, by Les Brown. All right, we're going to play that and we're going to feel completely inspired and motivated for our day. Even when things are going wrong, even when things look bleak, even when we've got concerns about money or concerns about life or whatever it may be, all right, we understand that once we do not give up, all right, once we do not give up, we will get to our destination, all right? Once we don't give up, we will get to our destination. If we give up and stop moving our legs or stop walking in a direction, then it's impossible for us to get to our destination. Guys, good morning. God bless.
One idea can turn your life
Good morning.
around.
God bless everyone.
Deciding
God
that you're
bless.
going to focus to develop
Thanks,
your
Jeff.
skills. A guy was the new owner of a baseball team that was in the basement of the league when he took it over.